Ladies and gentlemen, welcome. This is Christopher Aaron. I have a special guest with me today. It is the 21st of March, the first full day of spring here in the Northern Hemisphere, and I'm speaking with Francis Hunt. Francis is a technical-based trader and investor, very knowledgeable about currencies, commodities, precious metals. He goes by the name the Market Sniper, and he's really dedicated to an unemotional type of trading. I've been following Francis's work for a number of years. Francis, welcome and thank you for joining me.
Hey, Christopher, delighted to be with you and thank you for having me on.
Great. I wanted to ask you today, we have a lot of listeners who are focused on the precious metals. They really understand some of the fundamentals behind what is happening, debasement of worldwide currencies, a race to the bottom amongst various central banks, asset classes that may or may not be overinflated at a certain time. I wanted to ask you today, though, in your experience, these fundamentals, how does this compare with a more technical oriented approach of studying the markets?
Well, it's a very good question, and it's a very deep question. It's not one that you can quickly answer. My view is fundamentally, in terms of the time frame you are viewing any given chart, all the information is baked in. That doesn't mean markets are efficient. There's a big difference between that. I don't believe markets are efficient, and I think there can be wild and rapid readjustments. But in terms of the participants at the moment and who happens to have, and some people have views about the degree of control of the paper, gold and silver markets, in terms of the participation of the market mechanism we currently have, that is what is accurate for us. And I know there's this distinction between paper, gold and silver and being able to get it in. So even in a normal market conditions for my coins, if I want eagles, if I'm in the States or Britannia's over here, there's always, it feels like a 30% premium and you just want them. And even if you buy bars, you're going to be paying over the odds. And funnily enough, when the paper price really gets slammed, that actually can expand a great deal. However, I'm not, as we had a short chat prior to starting, I'm not a guy that always is the best time to buy. And those kind of people are often people that are sellers of bullions. Fundamentally, so there's a fundamental and a technical view. Fundamentally, we both are I think in the same school of thought that there's active devaluation of all currency forms across the globe. So longer run, I believe in owning precious metals. So I believe in an accumulate strategy. That is a non-leveraged accumulate strategy. However, even within that accumulation, if technically I can see they're going to take the price down or the market is indicating that there is weakness and it's going to sell off, I'll sooner put that month's allocation in after that sell-off has occurred. So that's where the technical analysis has occurred. So I've actually had an accumulation strategy and been trading precious metal shorts from 11 through to 15. Following the great sell-off in the precious metals. So actually my accumulation strategy, you could argue, is being funded by short selling the same asset, only because technically it was indicating to me that. And this was during the times of folks like Mike Maloney and Peter Schiff being buy, every clip is a buy clip. And unfortunately, entries matter, in terms of the overall return you get. Entries totally matter. And if you can optimize and be patient and take entries, there's no getting lazy about money managing your investment. Put the money aside, put it in a cash account. But if it's looking weak, keep accumulating the cash. That is part of your gold fund and wait for that sell-off to occur. So you have to be able to develop and to recognize the charting skills, which is something I focused a lot on, and it's part of my day-to-day work. That's a little bit trickier for somebody who's maybe got a full-time 9-to-5 job, maybe not necessarily had the same degree of interest as maybe you or I in markets as a whole. And then, the catch-all accumulates on a monthly basis generally will serve you well. Just be careful if ever you're putting in lump sums, because those entries really will be weighted, obviously, because you're putting in a big chunk. And try do some focus on timing.
That's great, Francis. Thank you. I find that mindset that you discussed, where you're able to almost split a part of your mind. So part of your mind is capable of going short at a specific time Whereas in another part of your mind, you understand the fundamentals and you want to be a long-term accumulator. I find that can really help me to feel very even about a market. It can reduce a lot of the emotional component of having to say, it's all now, all or nothing, and if it doesn't go higher, then my whole strategy has fallen apart. So it's very nice to hear that strategy that you're mentioning here. Let me move on.
I've got a comment on
yes,
that, if I can
please,
come in.
please.
And that's a really good point that you were making. There's some really good guys in the States. I'm actually having a conversation with a gentleman by the name of Rand Howell, who is a trader performance coach. So he's kind of the psychiatrist, but not the Band-Aid variety, the performance variety, and very specifically on trading. And the mechanisms that we have is that we're emotional and we trade the markets we believe, not what we see. And many people buy into the narrative of Schiff and Maloney, and I agree that they are correct largely fundamentally. I'm pretty much on page with a lot of them. Although, as I mentioned, I also think Harry Dent's right. We'll have the deflation first. We're going to have the fear first. So the point is, if that's happening, if the fundamental is right, you certainly want to be building a position. You don't want to wait till the event and then you face the lack of liquidity and the unavailability to get. So you should be acquiring, but you do need to time. You do need to time that. And the problem, people just get hell bent in belief. It's got to fail. It's got to go down. It's imminently happening, and they don't recognize that the charting in of itself, even if it's a chart of an imperfect thing. We could talk about the paper price of gold, which may have hands engaged in it. As long as it has a governing effect on what you buy for, even if you buy for a premium thereon, it is still important. So a lot of people say, "Oh, it's all fraud, it's all crap, it's all a rig, it's all a game. It should be $10,000." It only should be $10,000 when the market's ready to allow it to be that. Mm-hmm. And I'm not going to pay $10,000 now for it, especially when I can buy it at a small amount above whatever its spot price is at the moment. So you have to develop an element of that technical skill, and you need to know where you are if you want to get that optimization. And that optimization could mean a 10 times multiple on your kicker when eventually reset day or the event that we expect occurs. But it won't be a smooth ride, and the emotions will shake people out. It could go down first, and it will go down first potentially in an environment. I say it could. That's not a prediction saying it should or it shall. The problem will happen is that everyone will face a major cash restriction, and then people become forced sellers at absolutely the wrong time when they should actually be voluntary buyers. And being the 9%, most people understand because the 9% win and the 91% are wrong. However, sometimes you're a forced 91%er because the overall economic environment becomes so intense you can't hold on to that key investment at the right time. And that's where the price that you bought at before becomes so much more relevant, and how much other preparation you're doing for this recent event in terms of, are you also building a stockpile of cash? Do you have currency equivalents outside the banking system, which could involve some Ethereum or some Bitcoin? How, when they squeeze everybody's testicles real hard, are you not going to blink and start watering in the eyes and still say, never mind selling my gold, I got extra cash here and I've got enough to see me through this, I'm going to be a buyer? Because the next step that comes post the deflation and the testicle squeeze, if you'll forgive the phrase, is their cure, which is always the same: further currency destruction, greater proliferation, and then the revaluation again. Because the last bull run was based on 2001, the post-dot-com boom, we started moving, but it accelerated with the QE when the solution comes. But you've got to first survive the next bolt of lightning and even exploit it. And to be there, you have to be the 9%er. So I'm trying to warn folk that even if you make the right decisions now, they aren't the right decisions unless you can hold those decisions. And it's going to be a bumpy old journey. And you've got to think of it as that bucking bull that people go onto, the mechanical bull at a rodeo. Its game is to throw you out. The market's game is an adversary. It's not designed to make it easy for you to get wealthy. But instead of it being something where you need physical strength or I think you need planning and fortitude, and you need to make sure you're well resourced in the other aspects that you'll need to hang on.
Excellent. They don't call it a bull market for nothing. Francis, can I ask you about some of your work more specifically? Could you describe the volatility paradigm, the volatility theory that you primarily work with, and how can this be used to anticipate certain movements within the markets?
Yeah, so we've traded both to the short and the long side recently on gold, silver, and many other underlying markets. That's what I do, mainly utilizing this particular strategy. In other words, I'm a one-trick pony, and I actually think that's a good thing to be. We are sold that one-trick pony is highly limited. Rather have one really good strategy that you become a specialist in than be somebody who is a bumblebee popping in at every flower but never really quite gets to the nectar on any one of them. You have to become exceptionally good at executing well on one particular thing, and you get to choose what that thing is. And it's taken me the better part of 26 years to define the best camping spot on this playground. And I can certainly say the most emotionally comfortable, and I recognize psychology and emotions and staying with the trade. The money's made in the sitting, but knowing when to sit and when to get in and out is the big key element. And one of the great gifts of price behavior is when volatility itself usually swings, and I'm moving my hands as I speak now, in waves, which slowly dissipate, smaller waves, until they actually get to a point where they can get exceedingly tight, and you have what's called extreme low volatility price behavior. The benefit of these key critical moments, and hence the acronym, the Market Sniper, we both have a military background, and as a quick sidebar, in World War II, 250,000 rounds were fired for every actual fatality. That's a lot of lead flying around that ain't doing anything particularly productive. Now, that actually went beyond 400,000 in Vietnam, at a jungle and keeping heads down in the bushes. And, it doesn't get any more efficient. The hit rate for a sniper is 1.3. Compare that to 400,000. Now, I'm not a gun freak, and I'm certainly not a fan of global conflicts and wars. But as a concept of efficiency in comparison, one is just an entire different quantum plane to the other guy that's really just there to make a bit of noise and keeps heads down and hold a position until he leaves, and then the hill's taken back by the enemy. The other guy is an assassin. He is lethal and ties up entire brigades. Two of them can hold a town. And so the whole concept is you need that element of efficiency in your trading if you aim to be successful. So you have to select the key moment for when you take a shot, a triggering event. And one of the ways that snipers get 1.3 rounds fired for every fatality is that they don't fire very often. And as a trader, you're either in all the time and trading, day trading and churning an account and creating a whole bunch of fees for your broker, and a lot of them are 50-50, or you're being highly selective. But it's very unlikely you're being both. So that's one of the key elements. Now you get to choose at what point and at what juncture you take shots. What kind of conditions do you want? If we revert back to our sniper analogy, he always knows his exit before he fires. Snipers are typically reconnaissance. They spend more time watching and taking notes and observing and giving back intel than actually firing. As I say, they fire very rarely. They'll sit in a place for 2 weeks and not take a shot and go out. But when they do shoot, they don't shoot a single soldier. They'll watch entire patrols go by. They're shooting a captain, a major, or a general when the guys think that the area is safe because there's been nothing going on. They are highly selective, and that's what you want to be as a trader. And that low volatility moment is the rare moment when stops are not counterproductive. most people, in terms of the fashion that they utilize stops, is highly unproductive for them. In other words, brokers love you to have them. You're a negative scalper. You're scalping losses for yourself all the time. Why? Because of stop placement. People don't understand where to put stop placement. If you're getting an average pip range on the, let's say, the pound versus the dollar there of 160 pips a day, how can you have a 30 pip stop or a 40 pip stop or even a 50 pip stop? You're improving the likelihoods, if not today, that by tomorrow, wherever your entry is, unless there's a compelling reason and the supply is dominating the demand, taking you away from your entry very early in the trade. And that is the reason why we're at those low volatility events, because the expansion returns like a bang. It dissipates slowly, it returns like a bang. There's that asymmetry to it. It doesn't slowly get more broad, it suddenly shoots. And in fact, this strategy gets me into a lot of mergers and acquisitions. In other words, they form around known news events and unknown news events. I don't want to say too much on that kind of vein. I'll start to sound like Donald Rumsfeld. But the known events and unknown events, you will often get the DNA structure of that which I'm describing, low volatility. And that allows you to have a tight stop. The tighter you make that stop, that reduces that risk distance. That means, A, you can trade more size for the same unit of loss. So if you have a 100 grand account and you're trading a 1.5% stop loss or a 2 or whatever, that means you're in for 2 grand potential loss. And the sudden expansion of the volatility means utter dominance, either by the demand or the supply, whether you're going short or down. In other words, if you think of the bid and ask stack, instead of just flickering a little bit up and down, there's just a continual hitting of the offer or a continual hitting of the bid. And this means you get these impulsive bars. It also means you get gaps in your favor more often than you get gaps against your favor. I'm looking at an Oracle stock, one of yours, and they obviously announced great earnings. I still haven't read the earnings report, but there was a huge gap up, and it's all set up in an HVF structure that you would have been long in February, and you would have run it into the earnings, and you'd now be out. And we actually got a 25% on our expected risk reward on that trade, just on the gap on the news announcements. In other words, the inherent charting is already indicating to us that on balance of probability, whatever Oracle says is going to be accepted highly positively, which tells me there's probably a bit of a whisper number out there in terms of. So I'm not too virtuous about how successful Chinese walls work and insider information. I'm afraid I maintain a fair degree of cynicism about all these things. People are being given some decent guidance, and you can see it reflected by the lead steers. The lead steers is the big money in the market, and don't ignore that. So we've just had a great setup, and we've just gapped through our target and got 25% more than the calculated risk reward, utilizing the strategy. So that's a known event, because clearly that's in the calendar. But you also get unknown events such as I've suggested, mergers and acquisitions. So that's a little flyby. It's very difficult to give you an entire strategy explanation, but this is a key unique moment. Most traders that are trading are thinking they're trading above 1:1 and are actualizing well below 1:1. So I've had the benefit of both teaching trading and looking at people's P&Ls as they're learning, being around hedge fund managers that are trading really big lines and are very successful, and right through to the beginner and intermediates, and being reminded of the mistakes I made as well, because as you develop, you tend to, your new footprints take over from the old. And it's amazing. People think they're doing something, and we con our own minds. I say, well, let's look at your P&L. Oh, I got out of that trade early because of this and that. Okay, what happened there? I got out of that one early as well. I was a bit worried. I was going to see my mom. I didn't want it to open. Okay, so what happened there? Okay, throughout that week, for whatever reasons you've given me, you've not locked in. You've risked one unit, and you've claimed 0.4, 0.6, and 0.7. So you're averaging 0.65. So that means you have to win 75% of the time or 70% of the time, plus a bit of slippage and a bit of trades just to creep ahead. And the guy goes, oh, well, yeah, that's how I did it then, but I generally don't do that. And I say, I can only judge you on what you're doing. There's always a reason why you had to get out early, or you panicked, or you sold it, or you didn't like the price action. So people don't even stick to process. So their strategies may start out 1:1, and just what they end up executing and actually doing doesn't reflect that. In other words, there's a credibility gap between what you even think you want to do and what you end up actually doing.
Right. Right.
So yeah, we con ourselves a great deal, and we do not through intentional intentionally trying to be something we're not. It's just called mental enrichment. We remember the trade that won, and that was the one we did properly. All the others, there were mistakes. You didn't mean to do that. But had they won, they would have been one you executed properly as well.
So many valuable pieces of information in there. There's so many different ways that I could go from this point, and I'd love to have some conversations in the future about some of those things, especially the recon, the analogy of waiting for an extended period of time and then taking a very precise target with an investment or with a trade. Some really great pieces of information in there for all the listeners. Thank you for that. I wanted to move on to look at some specific price levels in the precious metals market, specifically in gold. Sure. At this time. And we're kind of looking at the long term here. Let's call it the medium term, the 10-year perspective of the gold market. And then we'll narrow it into really the shorter term, maybe about a year or 18 months or so. And I will pull up these charts on the broadcast when I do this so that listeners can have an idea of visually what we're talking about here, specifically for the gold market. And, Francis, we saw this low in December of 2015, just over $1,050 US per ounce in the gold market. And then you had just an incredible surge. I think it was the best first half performance in gold in 30 years, over a $300 rise in 6 months, up to around 1378. And then you had this second half drawdown, which really scared a whole lot of people out of this market, from my experience anyway.
Even though it was still up more than the dollar by the year end.
Yeah, exactly. And that sort of shows you the psychology that can happen. It's almost like the drawdowns cause a greater fear reaction, even though the market is at a net gain over that period of time.
People are very good at just remembering the most recent events. In other words, we totally imprint the most common latest news over the previous news. So it's very helpful to have a basis of comparison, and you take the entire performance under review.
Right.
Yeah, you're absolutely right. And the other thing is there's no fanboys in the mainstream media wanting to highlight its relative good performance because there's nobody who's paying or wanting that to be good. There's not an entire mutual fund industry behind it like there is behind, say, the S&P or the Dow or anything else, and looking to sell products off the back of it. There might be the odd gold ETF fund guy and maybe some of the people we've already mentioned, but they're not the most powerful voices. The gold market in scale relative to these other things just doesn't have that same level, which is one of the reasons why potentially insane gains could occur if there's even a small percentage of liquidity properly gets redirected into physical holdings, especially if it's taken out the system, which is why there is some possible credence to the 10,000 numbers. But that we'd start to see some signs in that technically. We were quite bullish for the beginning of 2016 on gold, and quite bearish about the markets for its start of the year. And I don't know if you recall, we had a China fear on the equity markets going into 2016 until there was roughly in March, there was a G8 meeting and the central banks all got their heads together. And I think China was cut some slack. I think some deals were done behind the door, and gold ran during that period up until about the mid 2016 and sold off in a fairly dull fashion the second half of 2016. What's important if you're analyzing this technically is that we've come down from 1920 to the 1,000. I think I got 46 here, but I think you said 1,050. It doesn't matter too much. And we then rallied up to 1380, which is the 38.2% Fibonacci. I'm not an over guy who goes nuts about Fibonacci in terms of it, but just in terms of understanding how far we fell and how far we bounced. 1920 down to the 1,000, we touched the 38.2%, which is significant because it's a golden mean number. And then we had the sell-off. Now the low in the back end of 16, which I've pulled a chart up just so that I'm talking accurately here while I speak to you, was 1,122.49. And then we subsequently started a bit of a rally. Now that low is higher than the previous low. So what we have now is the first up move that has created a higher high, and the first low that is higher than the previous low. Now, Dow theory is something that many of your guys will know, and the fundamental principle is the power of a new trend is where are you in a trend? Where are the highs and the lows relative to each other? So we have the first high higher than a previous relative high, and we have the first low higher than the previous low, which is still encouraging. But it's still early doors. If I'm sitting here looking at this monthly chart, I think it's potentially early doors of a new trend. But if we were to turn around and go down and sell that low of 16, and then threaten the absolute low of, not the absolute low, but the 2015 low of 1,046, you would have to say, well, then we just had a rally and we're still in the bear trend corrective.
Right.
Do I think that's a high probability outcome? No, less so now. Because we've already started laying the DNA of, okay, we could be ready to reassert. So where previously we were shorting throughout the 11, 12, 13, and 14, and I've got YouTubes of the actual trades that we were taking during that period and still accumulating. So one is trading is leveraged short time frame, and investment is unleveraged long time frame for me. So just so that some people have different mentalities about what investing and trading are, those are the two components that are relevant for me. So we're getting quite a lot out of a small down move on a short time frame during those years, and we were able to take it unleveraged into what I'd call your stacking strategy, if you want to call it that. Yeah.
So in summary, we'll look at for levels here. I'm just pulling up the 1-year chart, and I'll have that on the screen for people. We're looking at this higher low that formed at the end of 2016, right above 1122, and then we're looking at sort of the series of declining highs that we saw in 2016, and then of course the major reversal on the Trump victory day, where the price spiked momentarily above 1330. But really, there was a whole lot of selling that came in. So would you say those levels, the 1122 and then right around that 1330 level, are the key levels to watch for the intermediate term time frame?
Yes, I think you've dropped a time frame. Most of my comments that I was making was kind of looking at the monthly chart. If I drop it down, say, to a weekly level and try get more localized on what we're doing, and I do still would continue to say to folk, keep an eye on the monthly chart. This should be your long run strategy. This should be your alternative to currency. I do think there's scope for Bitcoin, although the difference I make with Bitcoin is it's even more volatile than precious metals. So the notion of it serving as a currency where you could potentially double or halve your money from one day to the next is, due to that volatility, is not feasible. But as an early adopter strategy, I have a slightly conspiratorial view. I think the control structures we serve under value having a Bitcoin out there because it takes money out of gold buyers. So Bitcoin is probably a substitute product. This said, to reward people that are early adopters and to direct more money, speculative money there and away from gold, I would expect it to do well as it has done. And the alternatives just below it as well. Look at the other cryptos. Some of them have got different and quite unique features to them. So Ethereum, there's a very interesting relationship with Augur, where they're getting smart people to forecast utilizing that, and that's how they can earn more Ethereum cryptos. So there's some interesting things going in, and I'm looking at getting involved in that. But the point is, if you have £100,000 or $100,000 portfolio, that's your casino money. $3,000, $5,000 of that. So we're talking about a very small percent. In terms of the gold and silver, I'm more of the traditional guy. I'd say you want to be, anywhere between 20 and 30%. And I would say you want to overweight in times like these. where banking failures are never far away, and having large cash sums which are not earning interests and are exposed to a higher than normal systemic risk is not necessarily wise. Have a certain amount of money in your bank, spread it across the best banks. I would certainly say I have offshore money. I do study on various countries and read certain research. You want banks that are highly have very good assets to the measure has just skipped me. Their liquidity to their lending book is exceedingly good, and you want them in countries as well where the central bank is not greatly indebted. This rules out the likes of where you and I are. I'm talking about places like Singapore and Norway and things like that. So if you're to have cash, have a working amount in your US account because that's how you are. Stack electronic cash in the banks that I've just described, in the places I've just described, if you can do that, and then have physical bullion on you. And then I also utilize a company that does bullion accumulation for you, and will store it at a number of locations in the world. And I choose Singapore. It also has Toronto, New York, Zurich, and London. I would say it's a toss-up between Zurich and Singapore, and I've gone for the East because even the Swiss can be leaned on. They're totally surrounded by the EU zone and by potential collapse. So I buy. Then you buy at spot, and they hold one-to-one relationship and designated money for you. And you can actually request, although there's a charge, and go and collect at some point. So there's a charge. But then you're buying without the premium. You're buying at spot. So I have a combination of all those things for preparing for the Great Reset. But you want to use charting for your timing. And that goes back to the strategy question you were asking me.
Excellent. So much valuable information here for everyone, I know, on so many different levels. And it's just great to be able to discuss the combination of the fundamentals, what's happening in the background with central banks, with the devaluation of currencies. At the same time, be able to discuss some of these important key trading concepts, the differences between trading and investing, the differences between accumulating the metals, strategies for accumulating the metals, and at the same time being open-minded enough to say, hey, if there's a drawdown in the metals, if there's a drop coming up, why don't we make, or attempt to make, if we're using the right strategy, a little bit of profit on the side, which then can be turned around and, for example, paid bills with or funneled back into accumulation of physical metal. I think you've really provided a wonderful synopsis here for everyone, Francis. So I do want to thank you for joining me today. And could you please tell me if there are any final words that you would like to leave for our listeners? And also, how can people find out more about the work that you do?
Sure, that's very kind of you, and that's great. I'll first make a comment on the gold market. So just for everybody's high, the 1380s at that 38.2, to continue to positively enforce an improving outlook for gold, in which case I don't trade it short at the moment, and I haven't done since 16, the beginning. If we saw the 1380 fall at some point, that would be underlyingly very good, because that would now be a new high after an already made new high from a dial theory point of view. And any pullback that came, if it failed subsequent to that and it failed to go as low as the 1122, then we're continually to put in smaller cycles on the bullish side. So that's what we most want. And for me, and like many of the others, we wish for that to happen because we want the system to be an honest system. But do not confuse your belief of what you want with what the market ends up doing. So you must always have that level at which the converse is occurring. So the run of the 1122 low and a threatening of the 1046 would mean that this has just been a blups of a rally, and we've made new lows. Don't think it's highly likely, and I think we're on a better track, but it's not ripping to the races either.
Right.
And I'm not going to tell you it's a raging bull if it isn't, but it's looking underlying like it's stirring. So that's that on the markets. I'd love to help people. We've got some great guys that have come over that are for trading. Some are fairly early in their trading careers, and some are even option traders. Just had a testimonial from a gent out in New York, but he's from the Southlands, working in New York, and he'd put himself in a $50,000 hole. Trading his options. He said since he started HVF trading, and I'm quite happy to share this with you. He's given me permission to share it. He did me a nice PDF. He's not only plugged the $50,000 hole he was in, he's now made in his last two trades $11,500 and $6,500. So he says he's the better part of $85,000 up in the last 6 months, and he's quit doing everything else he does apart from trading the HVF method. So, I have that gentleman's name, I have his testimonial, and it's nice. He's a US-based guy, so I put that in front of you. If people want to follow a little bit, got plenty of free stuff to go have a look at. The YouTube channel is quite active. It divides into my technical charting because I'm a man of many coats and colors, and it's also my somewhat critical eye on our current structure and mechanism. It attacks monetary policies, who's behind and pulling the strings, where resources are being directed. For example, we put a big militarization call out in 2013, and since then the likes of McDonnell Douglas and Raytheon and all of these, they've gone up 5 or 6 times. Same for some UK companies here. So wherever the liquidity is flowing, those stocks are going up, and certain people have certain agendas that they might be preparing for, and I discuss some pretty nitty-gritty topics as well. And it's all opinion, and it's pure speculation on my behalf, but I look for reasons as to why. So it'll be an interesting mix of technical charting and technical trading. And as I said, there's also for example, there's the Oracle call. We can share that with you, and you can put it on your blogs. But go follow the YouTube, and also at the Market Sniper on the Twitter handle. And I'm just changing my website, but when it's up, if they go to the old site, themarketsniper.com, there's a free webinar, 89 minutes, totally free, and I rip you through all the reasons why this technical strategy is the only thing I do. And if I've said anything that's remotely interesting, do yourself a favor, go to themarketsniper.com, see there's a registration for a free webinar there, and go watch that. And I think you'll come away with value regardless of whether you want to take anything further forward for that. And as I say, no charge to that.
That's excellent. Francis, thank you so much for joining us. We will keep an eye out over the next, at least on the short-term basis, on those levels that you mentioned, the 1380 for gold and the 1122. And I'd love to have you back on the show at some point, maybe later on in the year, and we can do another intermediate-term look at the precious metals and maybe some more trading philosophies.
Great. I love it. And a great thank you very much for bringing me on. And to all your listeners, stay the distance, guys. You're onto something, but make sure you're resourced that they don't shake you out. Stay with it and stock up on your cash, stock up on your gold, and make sure you got the resources to sit the bend out. They're going to throw another curveball and try to shake you out. You're onto a good thing, but don't get shaken out.
Great. Thank you, Francis. Take care now.
All the best. Bye-bye.